Hello everyone, I'm Trang. I'm from Group 11 of Accounting Theory and Current Issues. Today, my group includes me, Qureshi, Ali Zaib, and Tehmoor Rasheed. We present the presentation about implications of agency theory and positive accounting theory to organizations. Our presentation will consist of 6 parts. The first part is introduction that will be presented by me. Secondly, previous executive compensation research studies will be presented by Qureshi. Then, Ali will talk about the next 2 sessions, include incentive plan maximization, hypothesis, and actual cost benefit and incentive. After that is capital-based benefits compensation incentive will be presented by Tehmoor. Finally, Harris will talk about conclusion. Now let's start with the first part, introduction. In recent years, the accounting approach of the business plays essential role in achievement of effective corporate governance and minimizing the cost of contracts within a business organization. There are 3 types of contracts that take place in business organizations. Firstly, compensation contracts that are signed between the management and the business organization. Secondly, debt contracts that are signed between the business organizations and its investors. Thirdly, the contracts signed between the business organizations and the government regulators governing the business organizations within the host country. From the previous research studies, researchers found that these contracts are influenced by the management and the trust with governance to increase the outcome from the contractual-based incentive plans. Executive-based compensation contracts are explained by the 2 accounting theories, namely agency theory and positive accounting theory. In order to understand more about these issues, let's move on to the next part, previous executive compensation research studies that will be presented by Harris.
Hello, my name is Qureshi and I am presenting the next part of this presentation. It's previous executive compensation research studies. So if ownership and authorities are separated in an organization, it may give rise to conflict between the management and the shareholders and other potential stakeholders. There are multiple variables that can increase the management compensation incentive in an organization, decrease or delay in making tax payment to the authorities, political stability and reduction in political cost, decrease in the information handling and the management costs, elevation in the report revenues that are basis for the compensations. And the next part introduce my friend Ali Zaib. Thank you.
Hi, this is Ali, and I will talk about incentive plan maximization hypothesis. Uh, Haley conducted research in 1985 where he selected a sample of 1527 business organizations and took the period of 50 years where he discovered that the incentives and benefits are not linear functions of reported accounting revenue. Haley claimed that the incentives and benefits are piecewise linear functions that has upper and lower limits that are priorly defined in the formula related to the funding formula devised from the bonus calculation. Haley further explained the linear function. The segment was linear incentive function challenge the fundamental approach that represent that the management with incentive benefits plan choose revenue increasing accounting approaches and apply it to the business organizations. This Hallis theory of applying distinctionary accruals to the business organization to elevate the short-term incentive compensation as the base for the business maximization hypothesis.
Hi, my name is Tehmoor Rasheed, and I'm going to present the capital based benefit compensation incentives. The current global scenario has made it mandatory for the business organizations to align the management benefits and incentives with potential stakeholders. The latest approach, followed in the executive benefit compensation, is composed of five different segments, that is, basic salary, annual benefits paid, share options, share grants, and long term benefits plan. The current trend of increase in governance is due to the increase in the stock options of those charged with governance with the share price motivates the management to focus the operating and investing decision to increase the business worth. Now I'm gonna give you an example. For example, a director having high number of shares and holdings might manipulate the business income of increase to increase their share in the form of compensation benefits. Gao and Shrieves researched different forms of compensation benefits paid to the executives in a business organization, that is bonus, restricted stocks, salary shares, and long-term benefits. Government Streams argued that nonlinear payoffs from share options and benefit segment give rise to management incentives that may exploit revenue earnings to material levels, whereas restricted stocks may rise to less benefits to the executives. The research findings were that the share options holdings give rise to strong beneficial compensations for those charged with governance. Thank you very much. And now I will invite my other friend Harris to present the next part. Thank you very much.
Hi, now I'm presenting the conclusion of this presentation is, as you can see, the multiple approaches may be followed to devise plan to compensate the executives and create a link between the compensation benefits of those charged with governance and the organization worth. However, risks involved that may be used to manipulate the revenues that give rise to beneficial incentive and executive at expensive of the shareholders. Now, as you see the references of these presentations, and thank you for your attention. Have a nice day.